was going to say morning or afternoon, depending on where you are. Ladies and gentlemen, my name is Benjamin Barber. I'm the head of account management at FarmLab. So FarmLab, to describe what we do, we're a digital infrastructure company that provide environmental measurement capacity. And so what does that mean? So we're essentially a software company. And so the software that we provide helps people identify and measure environmental data. One of those things at the moment, obviously, is soil carbon projects, amongst the many different things that you can measure in the environment or on your farm somewhere. So from a software perspective, our software is used as the governance and measurement platform for about 30% of the soil carbon projects that have been submitted to the Clean Energy Regulator at the moment. And while that software is often utilized by people in the carbon developers, we also provide services, which is more about helping link up individual producers with trusted folks in the and independents in the community that they can help with undertaking a range of different projects. So today, I'm very honoured to have the lead-in segment to Andrew. And if anyone hasn't heard Andrew, he's and I did say to him yesterday, I'd say this a darling of the lecture circuit. He is, he's in very high demand around the place to come and discuss the taxation implications. Part of what Andrew's asked me to do as a lead up to this is to kind of identify the point in which you would go, great, I need to go and see a trusted, my trusted advisors, both from a legal and taxation perspective. So what I'm going to do is kind of go through some of the initial stages of what a project could potentially look like, look at that feasibility stage, and then really, I guess, lead into where you would undertake or I guess contact someone like Andrew, or, and to, I guess, get some of that trusted advice. So hopefully everyone can see that. Give it a thumbs up. Yeah, we're good. All right, ladies and gents, thank you. So as we said, the objective of my short presentation at the start is really to lead into Andrew's, where you're going to get a lot of really good information to support both you and, we're very privileged that Andrew is providing a presentation that will very much allow you to take, core elements and take that to both your local accountants to help them better capacity build. And that's something that both BDO and FarmLab are very much involved in, is helping to inform the greater community. And also from our perspective, we're not a carbon developer, so we don't actually run projects ourselves. There's other people to do that. We just provide measurement and governance activities for anyone undertaking environmental projects. So a brief introduction. As I said, I've got the lead up role. This won't take any more than 20 minutes. I'll hopefully get it done quicker because, again, everyone's here to listen to the more comprehensive reporting here from Andrew. We're just going to very briefly discuss some of the phases involved in a 2021 soil carbon method project. We'll have a broad overview of the first phase, which is planning out a project. And that's very much one of those first points that you're probably going to be looking to get some of that trusted independent advice. We're going to, and that's where we'll look at some of the key folks to discuss and who you can talk to. So references for my brief today really come from the legislation. So I provided this link there for those folks that might be the first time that they've considered looking into this. The legislation is really the core document that you need to have a look at. There is a lot of supporting information available through the Clean Energy Regulator website, which will, again, take you very much step by step through what needs to be done. This is very much the same things that anyone as a carbon developer will be looking to take you through as well. So what are the key phases that have been identified by the Clean Energy Regulator? So the first one is, again, there's 4 phases here that we're going to look at. The first one is planning your project. Again, that's fairly obvious as the first thing that you would be doing. And there's a bunch of different activities that we'll look at in more depth today involved there. It's not everything. Again, we just simply don't have time today. but we'll break down some of the key things that you can consider there. The second phase, which is registering your project, again, that's about actually taking all the information that you've planned and registering it with the Clean Energy Regulator. The third phase, that's actually the doing bit, I guess. So that's once you've been approved, you actually go out and undertake your sampling, look at your, actually undertake your missions, do the management activities that we'll discuss in our land management activity a little bit further on. It's basically the doing part of your project. And the final stage or final phase of this activity, reporting and crediting, and that's really very much the governance stage of this project. So that's where you're going to go and get, calculate your abatements, go through a measured or modeled approach, depending on what you're doing. You will then basically be allocated credits after you've gone through your auditing period. So again, very brief, but they are the four basic stages of phases involved in a project. As I said, what we're going to do is kind of look at now more of the planning part of that in a little bit more depth. So someone's coming for the first time and often we'll get folks that will come through and contact FarmLab and say, hey, I'm thinking of doing something, don't really know. What are some of the things that I should probably be considering now? So some of the key requirements that first often, irrespective of what pathway you go down, whether it's with someone from the carbon development space or it's going to do it yourself with trusted advisors, you're going to have to look at proving that you own the project area. So that's going to be like thinking about all those documents that you have that actually prove that you're going to, you have land ownership. And it's already a point, I guess, where people start considering about the long term, because it's not just about now, it's thinking about, okay, this is a project. And we're going to talk a little bit more about permanence period when we talk about independent advisors, but this is a long-term thing. So it's not just about what I own now, but starting to think about what I would own into the future. Probably the second point to look at there is, who do I want to work with? Am I going to go down the pathway of choosing a particular carbon developer to work with on this project, or am I going to go down that pathway of bringing together a collection of folks that I might have worked with in the past, or someone in particular that I've decided I'd like to independently engage, more of a fee-for-service approach? Again, there's a whole bunch of different options that are available and different, people within the community that you can engage. The point where most people will start to think about the taxation, so the financial and legal perspectives, when they start doing their first feasibility study. Now, we're going to have a little, a very brief look at what a feasibility study could look like today, but it is a broad, thing to undertake, and it is something that is critically important. If we don't get that feasibility study right to work out whether this is the right thing to do or even the right method or approach, there are lots of different things that you can look at, and some of them might not actually be a soil carbon project under the Clean Energy Regulator. Something that Andrew will touch on a little bit later will be things like voluntary markets. And while there's not a lot of folks doing that within Australia, it is certainly something to consider. From a measurement perspective, a lot of the things that you do in planning your project are fairly similar, irrespective of whether it's a voluntary market or something under the Clean Energy Regulator. Most of them will have some sort of project area. You'll have to do some form of planning, sample planning and stratification. You'll have to develop some sort of land management strategy. So broadly, they are often quite similar. One of the things that, is interesting during that feasibility study is when you start talking about land management activities and whether someone's actually prepared to change what they're doing. It is fairly critical, and we'll talk about land management strategies and activities a little bit further on. But, sometimes we come across folks that'll contact us and want to have a talk about their potential, and then something that they'll realize is they'll have to change something that they're doing. And that might be something that they're not particularly interested in. They might have developed an approach or undertaken certain activities for their whole career. And once they start to learn more about what they would need to do, it might turn out that this sort of project just isn't for them. The next part of that feasibility study, and we'll talk about it a little bit further in detail, is, again, independent advisors. So your legal and financial advice, and again, why that's so critically important. The final point there, which is something that's done sort of, I guess, concurrently after you've done the at least initial feasibility study, will be sample planning and land management strategies. We'll look a little bit more about those as we continue. So feasibility, some of the key things that most folks will do as part of their feasibility is going to be looking at defining the actual boundaries of the project. Where do they want to do this thing? They'll start to look at the different land management activities that they could help use to sequester carbon. One of the things when we talk about land management strategies is a very defined list of things that have been accepted as things that you would be able to either change or implement. And if, they're the things you have to choose from. And again, at this point, sometimes people decide that maybe this isn't for them because what they would like to do isn't on that list of approved activities. There are tools available that help. This is actually what you're seeing on the right-hand side of the screen is our integration with the CSIRO Look-See within FarmLab. We run an improved version as part of our work with CSIRO. And, one of the key things that it's utilized as just a broad estimate. Now, it's not to say at any stage that this should be the sole purpose or sole tool utilized as part of to determine whether you should go into a project or not, but it is something that is available, and I can talk, I guess, from, where I'm sitting right now on the Darling Downs on the information, the project that we've looked at on our place, that the results that came back from Look-See and comparing that to a full CER sampling that has been conducted in the last month or so, that it's not too far away. But again, some of the key things for consideration there are realistic expectations about the ability to sequester soil carbon within the environment you operate. And look, there's we could do a whole lesson just on understanding the environment and that ability to sequester carbon. One of the things that we're seeing more commonly and is seen as sort of best practice in this space is this idea of pre-baselining. So that's where someone, as part of their feasibility, will go, hey, yep, cool, we've got some model data that's come in, or, someone might have used remote sense data, a whole bunch of different things. I'd like to actually go and take some physical samples on ground and actually see what the disposition of soil carbon is across the place. And they're using that more for that due diligence process, just to understand what they're sort of getting themselves into. Because just like anything, model data versus what you find when you actually go and do some sort of ground truthing could be very different. The other thing is that data isn't necessarily wasted. It can be used to form part of the development of your sample plan going forward. So for those folks that haven't ever seen a CR compliant sample plan before, this is kind of what it looks like on the right-hand side of your screen. So, again, there's a whole lesson that can be spent just looking at what does a sample plan look like. But, some of the key things that you'll find is this idea of carbon estimation areas. How many do you need, or how many strata? Again, there's, depending on who you talk to, there's a lot of different, different considerations, different perspectives, and regionally based research that will help identify how many strata, how many carbon estimation areas, what activities are going to be run on the farm, that will help to define exactly how you define a sample plan. Another big consideration is how much is it going to cost to sample? That's often a consideration that people will need to take during that, post-feasibility phase. And again, still, they haven't submitted anything. They can pull out at any time, but this is a good thing to consider is what is my risk profile? So, how comprehensive do I want this sampled? Because obviously there's a regulatory requirement of a certain number of samples per strata, but there's also, from there is a bell curve based on, different research about how many samples you should take. But then that's always against the cost of doing that sampling going forward. So again, all these things that need to be considered in that planning phase of the project. Land management strategy. So first thing here for those folks that it's the first time seeing such a thing is that this is often something you can't do yourself. You must have must be prepared by an appropriately qualified person. And this is actually defined exactly the qualifications of that particular person. What a land management strategy will be looking to do is to really think about how can this particular project work in unison with the existing practices there. At the end of the day, this is for an agricultural project. We still need to be able to do that farming essential to, for a landowner to make a living. But it's just trying to work out how do they complement each other rather than being working in different directions. What we discussed before about the different land management practices is, one of the essential requirements is you have to demonstrate how you're going to do something new or material different within that carbon estimation area. So there's probably two elements there. One of it probably demonstrates pretty well that these things are generally done in unison and complement each other from both the land management strategy and your sample planning, because you kind of need to have both of them there to complement each other and to refer back and forth to each other. The second part there, importantly, is that you have to do something different. And this is a point that, some folks that when they get to this point and they're undertaking their land management strategy, this is why it's really, really important to trust in the person that's helping develop this with you, because not only do you have to do that new thing, but you have to be able to implement it and maintain that for a long period of time. And so it is really critically important that you find the right person to work with in this case. Underpinning, the final point there that I always think is critically important when we help to provide data and information to those folks that are developing this on behalf of a landholder is very much in that risk analysis space. Ultimately, a land management strategy should be appropriately robust to deal with the changing climatic conditions. It is essential for the period of time that these projects run over. So you often see that a deep appreciation of risk analysis and also project governance. Again, there's no such thing as a free lunch here, that, in order to whether, and as Andrew will talk about, inset or offset the credits generated as part of these projects, the reality is that you'll have to go through an audit process. And therefore you need to be able to demonstrate how, what system are you utilizing to record all the data for the life of that project so that you meet those governance requirements. So we're now at the end of, that I guess we're going through that initial stage. This is the time when we start to think about our independent advisors. Now, it's not to say that you wouldn't do this. And as I said, there's no particular order here. We often will see folks going in, after they're doing that initial feasibility, starting to go and talk to their independent advisors. But, unfortunately, it's often something that's not initially considered. Everyone's like, cool, I've heard this thing and I've heard about these carbon projects. I've heard it's a great way I'm going to make all this money. And they don't consider exactly how it's set up, who they're going through, and what does it look like. Now, I would emphasize here, all legitimate carbon service providers, before signing a contract, will expect that you've gained independent financial and legal advice. They'll absolutely tell you that it's highly appropriate. But unfortunately, we still find instances where folks are talked into contracts and they haven't been given these opportunities. And unfortunately, that leads to them being put in situations they'd rather not be in, or to the detriment of that particular provider. So again, it's essential. If you are dealing with someone that is legitimate, they are going to go, hey, go and get independent financial and legal advice before you continue. Or again, talk to other trusted advisors. I think the final point there is this is a marathon, not a sprint. You have a permanence period, which means that you have to store this carbon that you sequester into your soil for between 25 and 100 years, depending on what you choose. And that's really important when you consider what are the legal and financial implications of being able to run a project for that period of time. And again, Andrew's going to talk more about what some of these considerations should be. So in conclusion of the lead up role here before we bring Andrew in for the main event today has really been just to talk about very succinctly the 4 phases used to undertake a 2021 soil carbon project. We've done a little bit of a deep dive into that planning a project phase, just so that we understand what are some of the things that would be developed. Irrespective of the pathway that you choose to go down, you'll see that, there'll be similar things that will be produced. Really undertake a detailed feasibility study. I can't emphasize, it doesn't have to be expensive. It should be comprehensive, and it should really take into consideration all the things that you will need to do over the life of that project, not to just sign yourself up. And about talking to trusted advisors. And again, the whole point of today's brief is really that lead up. We will get to talk to someone who is an expert in accountant in the tax space when it comes to these particular projects. I'm going to hand over now to Andrew. We're going to hold questions to the end, but again, more than comfortable once this is concluded to work in unison with Andrew to answer any questions that you might have.
Very good.
Over to you, Andrew.
Thank you, Ben, very much. Just allow me to sort my technology out on my side. I think that should be coming through now.
While Ben does that, everyone just remember, if you've got any questions, you can send them through on chat as well. Over to you, Andrew.
Thank you, Ange. Just want to confirm people can see my first slide. Fabulous. All right. Thank you very much again for the invitation to speak on this webinar. I don't know that darling is precisely the adjective I would have used to describe myself, but certainly there is a lot of talk around the country at the moment in relation to carbon markets and carbon farming. And I think, properly, in my view, people are starting to think more than, just the initial on land aspect of that, and starting to think, more broadly, then what does this mean for my business, financial outcomes, succession planning, wills and estates for estate planning, and so on and so forth. So in terms of what I'm doing these days, a lot of the conversations that I'm having around the tax implications of carbon farming are with relatively sophisticated people who are, aware of the opportunities that carbon farming presents in the context of an agricultural enterprise, but looking a little bit more broadly than just the headline numbers and management changes per se, as important as they are. So I'm a partner in the BDO Corporate International Tax Practice, part of the Food and Agribusiness Network. And I'm based in Brisbane today. BDO acknowledges the traditional owners of the land where we are all located, and for myself, on Yagara and Turrbal grounds here in Brisbane. A good tax webinar never starts without a disclaimer. So here's mine. Tax is complicated, goes without saying. But I think the more important part is the financial product advice part of this disclaimer. And I just sort of harp on this. I don't usually talk about disclaimers, but it's important that I think we underscore the fact that Australian carbon credit units and I'm advised other voluntary units are financial products within the Corporations Act. They're regulated. And the advisor who deals with you in relation to buying, selling, trading strategies in relation to your Australian carbon credit units, or Australian carbon credit units more broadly, must have an Australian financial services license. I don't, so I can't give you that advice, but happily I can give you advice regarding the tax implications. So I think it's just important to acknowledge that. So without further ado, I'll jump into the tax implications of carbon farming. In terms of the content that I'm proposing to go through, I'm not intending to make all of you detailed tax experts. I've tried to keep legislative references and technical jargon to a minimum, but it is a topic that sort of does require some of that to be included. But I'll try and make as much as possible a plain English explanation for you. But if there's anything that you're sort of sitting there staring and going, "What on earth is he saying?" Just more than happy to take questions, as Ben mentioned at the end. So I'll talk about the broad tax implications, the way that the rules work. I'll then talk about some of the recent changes for primary producers, which is getting a fair bit of press at the moment and a lot of interest. We'll then go into some of the more bespoke elements around things like voluntary units, insetting, estate planning, structuring, so on and so forth, just to touch on them. And if there's time at the end, I'll speak about some biodiversity scheme type issues as well. Sound good? All right, so this slide is probably redundant for this audience, but just to set the scene, in terms of what I mean by carbon farming, obviously it's from an Australian context, it's the creation and generation of ACCUs under the Carbon Farming Initiative. So ERF methods, Ben's gone through the soil carbon method, obviously a lot of other methods that apply for, broadly speaking, primary production land. Some obviously in terms of the human-induced revegetation have attracted press a little more recently, but really talking about those kinds of methods that are generating carbon credits in connection with agricultural activities specifically. Flag on this slide, of course, that there are other networks and units which can be generated. We'll come back to that in a tick. All right, so remember that legislative note that I provided? Here we go. So I'll try and get my plain English going. So Division 420 in the Income Tax Assessment Act is our key source of reference when we're thinking about the tax treatment for ACCUs. So it doesn't actually use the term ACCUs, though. It uses the term registered emissions units. For all intents and purposes, for our unit purposes, we're talking about ACCUs. It uses language that talks about the holder of a registered emissions unit. And in that context, under the Carbon Farming Initiative, obviously we have a project proponent. It's important that the first issue of an ACCU by the clean energy regulator to the project proponent, they become the holder, and then subsequent transactions, there's subsequent holders. So I'll speak to those sort of concepts in a little more detail. Yes, make sure I didn't skip ahead 2 slides. So in Division 420 of the Income Tax Assessment Act 1997, treats ACCUs as, for tax purposes, what we call revenue assets. The alternative treatment, I guess, for an asset when we're talking about tax is that it could be a capital asset. And there has, in my experience, been some thought around the community that carbon credits are capital gains tax assets, and you're therefore able to apply, things like the 50% discount or small business capital gains tax concessions in relation to ACCUs. Unfortunately not. So ACCUs are revenue assets. They do not attract capital gains tax concessions, so I think it's important just to highlight that. When an ACCU is issued for free, as a result, well, effectively for free, no monetary consideration. You've obviously had to do whatever you had to do under the method. The issuance of the ACCU is not a taxing event. So an ACCU comes into your NREO account, you become the holder. You're not taxed at that point, or the holder is not taxed at that point. The taxing point, the first taxing point, is the gross proceeds from ceasing to hold. I've got selling on the slide, but the technical term is it's ceasing to hold an ACCU. So if you cease to hold an ACCU, usually that will be by way of selling, then the gross proceeds you receive are included in your taxable income. Where it can get a little bit funky is where you don't receive proceeds for ceasing to hold. But we'll speak about that in a moment. The rules contain a thing called a rolling balance mechanism. Now, if any of you have livestock and or trading stock inventory accounts, you'll be familiar with the tax rules around the change in value of trading stock. The similar rules apply in relation to ACCUs. So the increase in value is assessable to the extent that you hold the ACCU for more than a year, or the decline in value is deductible. So it's essentially a trading stock mechanism. The twist in that is that in respect of ACCUs, which were issued on or after the 1st of July 2022, individual primary producers don't need to apply that rolling balance mechanism. So just a little point at this point. We'll talk about that in the recent law changes when I get to it. Under Division 420, the rules say that costs that are specifically relating to the acquisition of an ACCU are deductible for tax purposes. The specific rules for ACCUs do not speak to the costs of conducting a method per se. So you need to sort of look into the broader tax rules in relation to whether you can get a tax deduction for the costs of conducting a method. In my view, that should always be the case. Where you can potentially fall askew of those laws is if the costs are actually private or capital in nature, and they don't otherwise get deducted under the primary production immediate deductions for things like water infrastructure and fences and so forth. As I say, most of the time we find that the cost of carrying out a method on primary production land tends to be deductible in any event. I've noted on the slide here that there's two sets of specific rules. One is where you cease to hold an ACCU other than in the course of gaining or producing assessable income. So you get an amount included in your income, even if you didn't receive proceeds for it. Ceasing to hold outside the course of gaining or producing assessable income is rare, so I won't go into it in much detail. And there are specific rules about ACCUs on the death of a holder. ACCUs are personal property. So if the holder of an ACCU dies and the ACCUs in the ANREW account become the deceased's estate, and they are dealt with by the legal personal representative. So the tax rules reflect taxing points for the estate and rollovers for the subsequent holders. So I guess the purpose of including this deep dive into the Division 420 is to say, well, we have this core, throwing my pen around here, we have this core set of tax rules which applies to ACCUs, and that's all well and good, but in the past it's created some weird interactions with the rules for other purposes. One of those big interactions has been the primary production rules, the tax rules for primary producers. As I guess most people will understand, individuals who are farming have access to a scheme called the Farm Management Deposit Scheme. There's also income tax averaging, which allows primary producers to pay an average rate of tax over a period. Both of those schemes obviously intended to sort of even out, if you like, the tax impact of seasonality in primary production. Now, the point is that both the Farm Management Deposit Scheme and the primary production tax averaging scheme rely on the primary producer having a significant amount, or at least no more than an immaterial amount of non-primary production income. So in those rules for farm management deposits and primary production tax averaging, we need to look at primary production income and non-primary production income. The question which has been long on the forefront of people's minds is gross proceeds from selling ACCUs are taxable income. Is it primary production income or is it not primary production income? And recently, as recently as July this year, the law was amended by the Parliament, and the amendments put into effect changes which were announced by the previous government. So David Littleproud was the Agricultural Minister at the time, and announced that the rules would be changed to ensure that income from ACCUs would be primary production income. I think at the time he said for eligible for, he said for genuine primary producers, which I found quite an interesting choice of words, genuine. I don't think he meant that they were trustworthy. But in any event, so the law has been amended. The effect of the amendment date was early July 2023. When the announcement was originally made a couple of years ago, everyone had the impression that it would have effect from the 1st of July 2022, and it does, but with a twist. It only applies to ACCUs that are issued on or after the 1st of July 2022. So bear that in mind. I'll come back to it because it's a really important point. So what the rules do is essentially they create a new class of ACCU for the tax rules, and they say that those types of ACCUs are primary producer registered emissions units. Essentially, the requirement is that the Australian carbon credit unit is first issued into the ANREW account of a primary producer who is an individual, or to a carbon services provider, which generally speaking is going to be a project developer, and that the ACCU is in relation to a carbon project which is connected with, and the legislation uses that phrase, connected with primary production, land on which a primary production business is carried on, farmland. When you go through the nitty-gritty, there's a couple of little nuances there. Individual farmers, obviously, that's it probably makes sense that the law sort of says, well, you have to be an individual, because individuals are the only people that are eligible for farm management deposits and income tax averaging. Those rules don't make any sense for companies or for trusts or, partnerships of things other than individuals. So, but because the rules refer to individual farmers, and that means like people, humans, if you have a primary production business being conducted by a company on primary production land, then the ACCU is in fact not eligible for these rules, even if it's issued to an individual who is the project proponent or the ANREW account holder. So there's some twists and turns that come through the rules. Taking a step back, it's individual farmers I've put here, but not trusts or partnerships can ignore the rolling balance mechanism. So the rolling balance mechanism that's the change in value of ACCUs from year to year. Individuals and only individuals who hold ACCUs that were issued on or after the 1st of July 2022 can ignore the change in value of those ACCUs. However, if you've got a trust that holds ACCUs or a company that holds ACCUs, they must still apply the rolling balance mechanism. It's also worth noting that the individual who holds ACCUs that were issued on or before the 1st of July 2022, sorry, not on, but before the 1st of July 2022, still has to apply the rolling balance mechanism on those ACCUs. To the extent that they still hold them. So yeah, so just to point that out, that 1 July 2022 date is really important. It's only in relation to ACCUs issued on or after 1 July 2022. ACCUs that were still on hand pre-1 July 2022 are not subject to these amendments. I don't think people fully understood that when the laws were announced. In my view, it would have been better to just draw a line that all ACCUs which were on hand at 1 July 2022 and bring them all in, but we don't have that luxury. So what does all that mean? If an individual primary producer is receiving income in relation to the sale of ACCUs, you need to trace through essentially where that income was from. So if there was a carbon services provider, so a project developer under a profit share agreement, the project developer sells the ACCUs and shares some of that with the primary producer. The rules allow that income to be primary production income. If a trust or a partnership that the individual is a partner in or benefits from is the holder of an ACCU and sells it, then the income can be primary production income when it makes its way into the hands of an individual. As I mentioned, the eligibility rules sort of turn on the nature of the ACCU. They require there to be a connection with primary production, land on which a primary production business is carried on. The way the rules work, if the primary production business is in fact carried on by a related company, no dice, they're not eligible. And the final point there, as I said, the ACCU sales income distributed through a trust or a partnership can be primary production income, but not rolling balance gains or losses. So you got this perverse outcome that a trust has to distribute its income. It must include in its income a rolling balance gain, potentially. And when that gain gets its way to an individual, then the individual can't treat it as primary production income. Doesn't make a whole lot of sense to me, but that's what the rules say. A couple of other points, I guess, which are not on the slide because it's sort of going into even more down the rabbit hole, but I think we've got time, so if you'll indulge me. The law says that to be an eligible ACCU, there must be a primary production business carried on at all times in relation to the ACCU. So at all times potentially means every one of the 25 or 100 years of the permanence period. So I'm puzzled about how that's going to be assessed or enforced. I presume that if there's a property sale at some point, and the new owner doesn't carry on a primary production business for a period of time, but it still relates to the land, I assume that there's not going to be a look back to say that all of the ACCUs which were previously issued were no longer eligible, but we'll wait and see about how that's administered. You might recall I mentioned this connected with concept as well. So if land is connected with, the law doesn't really tell us how to establish that. So in other kind of tax contexts, when we're talking about land, that connection can be sort of physical. It can be next door neighbours, for example. A carbon project area might be on the next property, or a property which is a short drive away. To the one where the carbon, to where the primary production business is carried on. This is kind of going to be relevant for methods which exclude, animal access or things like that. But what about where you've got a situation where there's a primary production business carried on a property, and the same property owner has another property which is like 100 k's away, on which the carbon project area is carried on? Is that carbon project area connected with the primary production property because of the same ownership? Is it connected with it because there's a road network that drives between the two? The laws are not really clear. Our best estimate is that it will be a physical proximity would establish connection. So the further something is away from the primary production area, the less confident we would be about it being connected with. But those sorts of fact patterns, I think, are going to be, to be investigated in the coming years after these law changes. Did I say that tax is complex? And as I said, more than happy to take questions in relation to anything that I'm going through here. Carbon service providers are covered in the law, as I said. So most most common arrangements which should be covered, profit split arrangements and ACCU share arrangements. Again, the law basically says if the ACCU would have been eligible had it been issued to an individual, then it's still eligible when it's issued to a carbon service provider. The one carve out is where the carbon service provider is paying the individual a lease amount. This will depend on the contractual terms between the developer and the landowner as to whether payments constitute an amount for land access that is a lease. Most of the time, I shouldn't say most of the time, in my experience, it's common for land access agreements where they're necessary to have a minimal consideration, so you don't end up in this situation, but it's just something to be aware of. If there's a payment which is structured as a lease, then that's not primary production income when it's received by the landholder, even if it's funded out of the sale of an ACCU. Alrighty. Other matters, quickly gallop through these and then talk about biodiversity for a minute, and then we'll go to questions. So voluntary carbon schemes, as I mentioned, Vera, gold standard, ISO certified schemes. These are not, in terms of absolute numbers that are of projects that are conducted in Australia for these kinds of schemes, I don't know that it's sort of vast. There's certainly a lot of interest in it. The important thing is that they're not covered by the rules regarding ACCUs. I've asked the government to consider including them because, as some of you may be aware, Climate Active will allow you to certify a product or an event or a building or whatever as carbon neutral by using Vera units or gold standard units in addition to ACCUs. So from a voluntary certification basis, you can use these, but they're outside the tax rules. So as a consequence, you need to do what I would say is a first principles revenue capital analysis. I don't want to bore you with that, but you can end up with different outcomes to the ACCU rules. So just be aware of that in relation to voluntary carbon schemes. Insetting is an interesting emerging area. Insetting is broadly it refers to the use of carbon certificates to offset emissions in one's own supply chain or the supply chain of a producer upstream. Downstream supply chain. What that looks like on the ground is you might have a primary production business which might be selling cattle and has a carbon project running alongside that cattle production business. The ACCUs which are generated in that project might be retired to offset the emissions that the cattle production business generates. Now, this is complicated, obviously, because it depends on the overall carbon management strategy of the business and at the point in time at which the emissions need to be offset. But that's the concept with insetting. Suffice to say, the tax rules don't play nicely with insetting. The retirement of a carbon credit is ceasing to hold. And you might recall from my earlier slide, you're taxed on proceeds you receive from ceasing to hold a carbon credit unit. If you don't receive any proceeds because you just offset your own emissions, then it's not a taxing event, which is great, you might say. Can you arbitrage that? Probably not, but with the rolling balance mechanism being switched off for individuals, it presents some interesting outcomes when you model through what the tax outcome can be if you're an individual primary producer and you're insetting. So watch this space. It's an emerging area. I don't think people have got their heads around it. Succession planning and more broadly estate planning. As I said before, this is an important area. ACCUs are personal property. And at the moment, Australian carbon credit units are not vintaged. So a sequestration, a ton of carbon sequestered 5 years ago is good to offset an emission today. That's not necessarily the case in other systems around the globe, but it is a feature of the Australian carbon credit unit. That means that people have in their mind sometimes that they're just going to bank a whole bunch of ACCUs and pass them on to the kids, which you can do. But it isn't necessarily going to be good for the environment. You might not necessarily get the same price point if it's a very old ACCU. B and C, consider the estate plan. Pre-entry tax planning, state tax. The state tax point is very important. Most jurisdictions, I think all jurisdictions around Australia, have land tax, and they have land tax exemptions for primary producers. Land tax exemptions for primary producers, as far as I'm understanding, do not consider carbon sequestration activities to be a primary production activity. So just be aware of that. If there's a significant carbon area on what would otherwise be primary production business, then there might be some issue with the land tax exemption. Land tax is something which is not in my wheelhouse, so it's not something that I can speak, much more knowledgeably to, but it's definitely an important point when working out the costs of undertaking a carbon project. Interaction with other offset and credit schemes. Look, I won't cover that too much, but I'll speak about biodiversity in a sec, but suffice to say the ACCU rules apply to the ACCUs, everything else applies to everything else. And CGT rules, as I said, ACCUs are not CGT assets. Carbon areas are considered to be active business areas for the purposes of the small business CGT concessions. So there's some ATO rulings which support that position. That's going to be relevant in relation to a property sale. So certainly a lot to consider in relation to carbon farming, whichever way you propose to do it. There are tax implications that I think go more beyond just the headline, when do I pay tax? And you need to sort of look outside that and say, well, how about my overall affairs and how should that all be structured? The one thing that's not on this slide and probably should be is the non-commercial loss rules, which have relevance for people trying to deduct primary production losses. Non-commercial loss rules essentially have a hard income ceiling of $250,000, whereby if income is more than that amount, then primary production losses can't be utilised by an individual. If you've got individuals holding and trading ACCUs, generating ACCUs and selling them, it doesn't matter whether they're primary production income or not. You could potentially pretty easily breach that $250,000 threshold. So something else to be aware of. All right, conscious of time, quick implications of biodiversity. Suffice to say, biodiversity has been around for a little while, state-based schemes that create offsets or credits, depending on which state you're in. The Parliament is debating the creation of a biodiversity certificate scheme. The previous government had a similar bill before it. There's a conservation covenant concept in Australia as well, which is relevant to this area also. Biodiversity does not have specific tax rules. Yeah, I remember I mentioned this revenue capital analysis. When we're talking about biodiversity schemes, unfortunately, you have to go back into a fairly deep dive analysis of the facts and circumstances of each case. Are you dealing with a business? Is there not a business but some other intention to make a profit? Is there a conservation covenant? How does that interact with the landholder's title and tax rules? And suffice to say that it's all a bit of a schmozzle, but it's necessary. My hope is that when the government legislates the national scheme, there might be consideration given to a specific tax rule which operates similarly to ACCUs for biodiversity credits, because I think it'd tidy it up and make it a lot more easy for people to understand, or at least have certainty. For those of you who are interested or don't sleep well at night, there's a private ruling which is quite good in relation to biodiversity credits. You can get this by Googling that number. And it sort of goes through some of that revenue capital concept, which I won't go into now, but you can sort of see what the level of detail is and what the implications are. So biodiversity, as I say, it's more common, I think, these days to have carbon projects and operate some other co-benefit alongside it, which might be biodiversity, which might be socio-economic, whatever it happens to be. You need to look at each individual asset, if you like, which is produced out of that arrangement on its own merits. And fair warning, it can be complex, but once you get it worked out, it's more or less set and forget, or should be more or less set and forget up until the point in sale of time in which a sale occurs or some other change occurs. Okay, so just in the remaining time, just a quick overview of what BDO is able to do in this space. BDO operates a sustainability practice. We're involved in carbon footprint measurement, all the things that are on the slide there, Australia-wide, and we are able to do everything from decarbonisation strategy, NGR audits, tax advice, etc., etc. These will be in the slide, so feel free to have a more detailed read as to what we can do and reach out if there's anything at all that we can assist with. BDO runs a number of webinars every year. This is our 2023 schedule, just around sustainability and things like accounting and business interaction for people to watch. So they're always very well attended and received. You can sign up for insights, have a look at our courses and webinars, or reach out to any of the lovely people on this slide, including myself. So I might just stop sharing my screen here and throw back to Ange or Ben or anyone to take any questions.
Thank you very much, Andrew and Ben. Yeah, and yes, look, we've had 2 questions come through on message. I think maybe you might have touched on the first one that came through. So Stephen Stacey did ask, Andrew, would retiring or insetting ACCUs into your own operation attract a tax consideration? I think you did touch on that. Do you feel like you covered off on that one?
I kind of did cover it off. So essentially, yeah, if you when you retire an ACCU, you cease to hold it, right? So it goes out of your ANREO account, you cease to hold. The taxing point, as the law is currently drafted, is ceasing to hold. The taxing amount is the proceeds you receive from ceasing to hold. So broadly speaking, under the current law, when you inset or you cease to hold an ACCU and you don't receive any proceeds, then there's no taxing point. Well, there's no taxable income. There's a taxing point, but there's no amount to include in income. The reference that I made to the rolling balance mechanism and trying to, well, whether there's any arbitrage on that concept is this. The way the rules work when you've got a rolling balance mechanism is you are effectively picking up, or you can effectively be taxed on that ACCU if you hold it for long enough prior to like ceasing to hold it, because the rolling balance mechanism picks it up in its closing balance. But where you're an individual primary producer and you don't use that rolling balance mechanism, you technically are never taxed on that ACCU.
Did you have anything to add or question that one, Stephen?
Yeah, so is the answer so is there the tax implication, if you haven't received funds for it but you've used it against your own business, there would not be any tax payable on that?
Basically, that's how I read the rules. It's an in and an out.
Yeah. No worries. But the same credit could attract tax on the rolling value.
Rolling balance. Yeah, correct. Yeah. Yep.
Okay.
Thanks, Andrew. The other question that's an interesting one that Anne Coote just sent through a moment ago. How does an extended drought period impact on carrying out primary production at all times for tax purposes?
Yeah, great question. Again, this is where the sort of the drafting of the law is not particularly helpful. And there's a range of circumstances, right, where you can consider that primary production businesses might not be carried on at all times. In my view, the best expectation that I hold is that there's a primary production business or an intention to carry on a primary production business. You know, drought has got in the way, but there's still all the other indicia. Indicia is a technical term, a little bit like, anyway, sorry, like everything else that you would ordinarily expect to see in a primary production business happens. So there's a business like conduct, there's records kept, there's bank overdraft, et cetera, et cetera. So I expect that extended periods of drought should not impact that requirement. I think where it becomes a little bit more sketchy, again, to employ a technical term, is where you have an extended period of literally no intention of anyone to carry on a primary production business, as we sometimes see in intergenerational property transfers, where you have a patriarch. I'll use that because that's the stereotypical situation. A patriarch who has farmed for many years and becomes unwell, and the children cannot agree on who's going to take that property on, and therefore it sits dormant for a period of time. In my view, those sorts of fact patterns probably will make establishing a true line of succession on primary production activities more difficult. But that's just my professional speculation. But the law hasn't really, and the supporting information hasn't really teased that out. So we'll keep an eye on that space.
Thanks, Andrew. Anne, did you have anything to add to that question that you put up for Andrew? I can't.
No, that's all good. Thank you, Ange. Thanks, Andrew.
No worries,
No
Anne.
worries, Anne. Thank you. Does anyone else, I've just addressed the questions that came up on the chat. Has anyone else got a question for Andrew or for Ben? Speak now or forever hold your peace.
Hey, Simon Brown here. Thanks, Andrew. That was great. And thanks, Landcare, for coordinating it. Andrew, we spoke actually at a conference recently. Is some of this information, how you going? Is some of this in fact sheets? Like, are you going to put some of this information into fact sheets? Because it feels like for many of our people that we work with, this is really great information to then help them to actually go find an accountant or push their accountants a bit. So, like, you know, if they're working with accountants that haven't spent a lot of time thinking through some of this. I worry a little bit that people will go to a rural accountant that hasn't spent a lot of time in this space and sort of not realise some of these implications.
Yeah, I think, that's a sort of an extension of the conversation we had at the conference. So just for the benefit of everyone else, I think so from a BDO perspective, we have a variety of different articles and that we put out on our website. There will be an article that goes live this week in relation to some of those, a deep dive into some of the technical issues around the individual primary producer rules. We have not done like a public series as such of fact sheets around this, but you know, these presentations and slides are frequently recorded. But it's a good idea, and I think people are tending to do these on a bespoke basis. So I think there's an opportunity to do that.
Sorry, just to confirm, so those fact sheets, that what's put on the webpage, the article, will you flick that around or will someone flick that around? That'd be great. Thanks, Andrew.
Thanks, Simon. Excellent question. And Andrew, and we will, for everyone's sake, and Andrew and I had spoken about this prior to the meeting this morning, that, we will share any of that relevant information with everyone. And so that you can then share out the recording of this webinar as well as anything that Andrew can attach to it to your relevant tax people, because like Simon just said and Andrew has alluded to, just extra information for local tax agents. It's a big thing that they're dealing with. So we'll share as much as we can with the recording share that we do tomorrow, Simon and everyone.
Wonderful. Thanks, Angela. Appreciate it.
No worries. Anyone else got any questions for Andrew or for Ben? You've stunned them all into silence, I think, fellas.
Oh, it was Ben. It was all him.
Yeah, I was going to add that. I like certainly, and again, I can't thank Ange enough for putting this together. Andrew and I have been discussing doing this for some time, and certainly, it's just something that we consistently find in the market as people are doing their feasibility and they don't appreciate these things. And it's just something that was critically important today for us to, and again, thank you to Landcare and to Ange for putting this together, to start to capacity build and to allow this information to get out into the broader community so that folks can help, make an informed decisions about where they'd like to go. If this is something that they would like to do as part of their primary production, that they're well informed about what some of these considerations are.
Thanks very much, Ben. And that's exactly why we're doing this, just to help inform the people that we work with, the land carers. So thank you so much, Andrew and Ben and everyone else for getting on. I will share out the recording tomorrow with everyone, plus any additional info that Andrew and Ben can add to it. So it'll all come to you. And also just know that I've already been picking Andrew's brains and Benjamin's about some follow-up from this, because I think the tax implications around the emerging environmental markets is a big question for us all. So Landcare Farming will aim to keep you all informed as much as we can. And please likewise reach out anyone on this call or any of your colleagues. If there's anything that that Landcare Farming, Landcare Australia can support you with, please come to us. We need to be told by the people that we work for and with what you guys need as way of support. So look, thank you everyone for coming on. Did you have anything to add, Andrew or Ben? Or
no, I'd just like to add my thanks to what Ben's already said. Very much appreciate Landcare organising this and the attendance of everyone today. More than happy to have a chat. If anyone wants to reach out, please do.
Thanks, Andrew. Simon just put up a quote that said, "And humour in a tax presentation doesn't get much better than that." I'd have to agree. Who would have thought, hey?
Thanks. That means a lot to me, Simon. Yeah.
No worries. Well, look, thanks everyone. It's been a fantastic presentation, Andrew and Ben. Thank you so much. And we'll get the recording out to you all, and look forward to me annoying you, Andrew and Ben, both within the next couple of days.
No worries. Thank you.
Thanks all. Take care.
Have a great day. Bye-bye.
Bye. Thanks. Bye.